NVIDIA shares are down on reports that Meta is considering using chips designed by Google. Let's get more on this with Jack Manley. He is the global market strategist at JP Morgan Asset Management. And Jack, thanks very much for joining us.
Yeah, well, thank you for having me, Roger.
A bit of a shakeup today with what's unfolding. How are you reading all this?
Yeah, I mean, I think what's going on today really underscores a couple of things. I think it underscores the risk of making any, single big concentrated bet on any one particular security. But it also underscores, it really highlights, frankly, something that we see happen over the course of many technological, let's call them revolutions, right? This idea that leadership is going to pass from one company to another company as that technology matures. Now, in the past, that leadership change has typically gone where the baton is passed from what's referred to as the makers to what's referred to as the takers. The makers being the companies that are actually laying the groundwork, building the infrastructure. The takers are the upstarts, the newcomers, the ones that kind of show up out of nowhere, take that technology and revolutionize a business model. Probably not as much of a risk of that happening right now in this market. These companies have a lot of cash. They're pretty loosely regulated. They can gobble up small upstart companies very, very quickly. But certainly some risk of the big players sort of jockeying for pole position. All it takes to get good in this space is money, and we know that these companies have plenty of that. So not particularly surprising. For me, it was more of a question of when, not if, that something like this would happen.
Now, does this leave NVIDIA kind of on the outside looking in, or is there still lots of room?
I wouldn't say that necessarily. There is so much money sloshing around out there in this space. There is so much fiscal support, administrative support for AI and the build out, particularly in the United States. I think there are plenty of opportunities for a lot of different players in the AI world to continue to make quite a bit of money. So I wouldn't say anybody's being shoved out at the moment.
So there's lots of room for that. Okay,
yeah.
I want to move over to talking about the GDP. The numbers are coming out for Canada this week, and what a big difference. I was looking, the U.S. is tracking at close to 4%. We're likely going to be flat.
Yeah.
They're leaving us behind.
Yeah, I mean, first of all, envious that you guys are getting your numbers out on time. We were supposed to get our third quarter print out a couple of weeks ago, and that did not happen, obviously, because of the shutdown. But to your point, we do have some insight into how these numbers are shaping up. And third quarter growth in the U.S. is looking to be fairly strong, close to 4%. Third quarter growth in Canada looking to be pretty close to flat. This divergence here between these two economies, something that we've seen happen for quite some time at this point. Long before, actually, the trade war kicked off back in April. There has been pretty significant divergence between the economic performance between these two countries, really going back to the pandemic. And I think what that does, right, is underscore, again, some of the risks, headwinds, I suppose, that the Canadian economy and in particular the Canadian consumer is facing right now. We know that the transmission mechanism for higher interest rates is a lot more effective here in Canada than it is in the United States, in the sense that mortgage rates get refinanced very quickly. Homeowners see those higher rates passed on very quickly. That's a depressive force. We know that policy change out of Washington has been a source of confusion, of course, but also a real negative in terms of economic activity. The Canadian economy very tightly levered to the U.S. economy, 25% of GDP coming from exports, 75% of those exports headed here, or rather headed for the States. And then, of course, you have a labor market that's considerably slacker here in Canada than it is in the U.S. What we're going to be seeing this Friday with GDP is, I think, confirmation of a story that we've been telling for a while now.
And is this a transition, does it feel like, for Canada, or is this something that we still haven't figured out?
I don't think anybody's really figured it out at this point. I mean, the rules of engagement, particularly as they relate to trade, are touch and go. They change pretty frequently. And when I think about what 2026 has in store, it's going to be more of this policy noise. Now, Washington, for a long time, was being pretty noisy. Ottawa may get in on the party as we move through next year. But I do think that's going to be one of the big themes for investors in 2026 is a lot of policy change continuing to inject uncertainty, I suppose, into the macro landscape.
And then in the middle of all this, you have the TSX outperforming the S&P 500. We'll just throw that in there.
Yeah, I mean, it's kind of interesting, right? That the divergence from an economic perspective has been a negative one for Canada, but the divergence from a markets perspective has been a positive one. And I think it is a good reminder that the economy and the stock market are not always mirror images of each other. It's tempting to think of them like that, but they aren't necessarily mirror images of each other. But I think it also helps to tell a story of a Canadian equity market that's caught a bid on a couple of things that have just worked really nicely this year. We know, for example, the valuations were a compelling story at the start of 2025. The TSX trading cheap relative to its history, certainly cheap relative to its U.S. cousin. So valuations ending up being a nice tailwind for performance. We also know there have been some very sector-specific, almost idiosyncratic stories that have driven the TSX higher. You got gold prices up, like 40% this year, a huge boon for miners, the materials sector doing quite well. We know the interest rate environment has gotten a little bit more benign for banks, at least. Net interest margins have improved. It's been great for financials. I like what's happened to the TSX this year. I think it makes a whole lot of sense. What I would be cautious of, though, as we look into next year, is reading too much into the outperformance from 2025 and assuming that it's repeatable, that it's replicable in 2026. I am not looking for another 20+% return year out of the TSX, and I'm not looking for Canadian equities to outperform their American counterparts next year.
Okay, we're going to leave it there. Jack, thanks as always for joining us.
Thanks for having me. Great to be here.
Jack Manley is Global Market Strategist at JP Morgan Asset Management.